On this episode, we decided to do a purely Q&A show, and I think it turned out to be one of the best shows we've done so far. We talked about the risks associated with raising capital later down the line, specifically discussing the audited financials requirements that most people forget about. We talked about what happens when you are short on a raise and what options you may have. We talked about the basic fund of funds setup, and a ton more questions, which we've timestamped below so you can check them all out. Today's giveaway is a free 30-minute coaching call with me, yours truly, and here's how you can win. Number one, leave a comment below this video within the first 24 hours of when we drop this video. Number two, subscribe to the channel. And number three, turn on notifications. And if you win, we'll let you know in the comment section below. Let's get to the show. What does it look like to bring on investors later down the line? Meaning 2 years after you've started your PPM or your offering versus right at the beginning. There's a lot of things that happen when you do that. And this can happen, by the way, on both a project-specific deal or a fund. It usually happens in a fund, but in a project-specific deal, the way it could happen is you need to raise, I don't know, $1 million for your raise. You get enough to close on the deal. So let's say you raise 900 grand or something, and you have enough to actually close on the deal, but you still need to, you need to get your acquisition fee. There's maybe some reserves or whatever other expenses that you don't need for closing. And you figured, hey, I'll just continue to raise after the close, which is something you can do, especially if it's outlined in the PPM documents. So that's one scenario, but most likely it's a fund. So when you've got these, not evergreen funds, but some of these funds are just open for a couple of years. My recommendation is usually just try and raise all the money up front, and then just try and get it all done in the first 3 months. But some people take a year or 2 years to raise, $50 million or whatever. And that's fine. It's not an issue per se, but there are some issues that pop up. And the biggest one from a legal perspective shows up when you're doing 506B deals. It's less of an issue with 506Cs, but with 506B, most people forget, and I understand why, but most people forget that one of the prerequisites of 506B is to provide your non-accredited investors with audited financials, right? And most of the time, that's not an issue because it's a brand new company, right? We set up a brand new LLC. There are no financials, let alone audited financials. And so typically we don't worry about the audited financial portion of that. However, when you've now been in operations for a year or 6 months or 2 years, and this is a specific example, 2 years later, well, now you have been in operation. Now there is an LLC, there are financials. And so you have this obligation to not only continually update your PPM, because obviously when you drafted the PPM, you just had a bunch of pro formas and a bunch of, whatever your guess was and your assumptions, but 2 years later, those are no longer assumptions. You have 1.5 or 2 years worth of financials. And so you've got to continually update your PPM and your offering documents if you're going to be raising a year from now or 2 years from now. So that's the first thing to keep in mind. But in addition to that, if you were to bring in non-accredited investors down the line 2 years from now, well, now you do have to provide them with audited financials because, again, you've been operating for 6 months, a year and a half, 2 years, 5 years, or whatever it is. And so you do have financials. And so that's a cost that isn't the end of the world. It just means you've got to count that in or budget that into your budget and spend, I don't know, 20, 30, 40 grand, depending on how many transactions you have. So that's probably the biggest, from a legal perspective, issue when you continue to raise months and years later, is if you have non-accredited in the future, you've got to not only update them with disclosures, but part of those updated disclosures are going to be audited financials. Now, even if they're even if they're all accredited, you're still going to probably need to give them updated financials. Again, somebody's investing 2 years down the road. A lot has happened since you drafted those PPMs. And so any sophisticated accredited investor is going to want to look at your books for the last year or 2 years, see how you're doing. Your goal was to acquire all these properties at these prices. And well, now it's 2 years later. So let's go take a look and see whether you've actually been able to do that. So that's probably the biggest thing to think about in terms of a legal perspective. The other one is obviously just how are you going to treat the investors from a return perspective? In a fund, a lot of times, you're getting them, let's say if it's a fund that you're just paying somebody a flat return, like a pref, you're just giving them 12% or whatever, then it doesn't matter whether they came in as your first investor or they're coming in as your last investor, because it really doesn't matter. Everybody's getting 12%. But if you're not, then you've got to figure out different pricing mechanism. You probably need to, you don't have to, but probably need to, because it would obviously be a lot riskier for an investor to put in the first dollar than it is for somebody to come in 2 years later when everything's already running smoothly and you bought a bunch of stuff and it's more stabilized. And so arguably the risk is less. Are you really going to have that investor pay the same price as the investor that came in at the beginning? Most likely the investor at the beginning is going to want to have generally a discounted price, right? So if the first investor came in at $1,000 a share, great. 2 years later, the new investor might be $1,200 a share or $1,100 a share, membership units, but I'm using shares. So just the pricing mechanism and all that has to be thought of ahead of time and disclosed in your document, so that if you're planning on doing a raise, it's going to last 2-3 years or 6 months or a year, you should put in there what's the pricing mechanism, because if there isn't any, then the investors are probably going to be like, well, why would I give you money now if I can just wait 2 years and come into a deal that's already stabilized, has some cash flow, I can see how they performed. Why don't I wait to go into this fund as opposed to put the money in right now? So I think that's the big thing when you're bringing in investors. I see a couple of questions related to that. So before I go to the other one, let me just address those. Joanne was saying, what does audited financials mean? It isn't enough to just give financial. Who audits the financials? That's a great question. We do have a couple of CPAs in here. It's generally not a CPA, by the way. So audited financials essentially means some independent firm, an accounting firm, is literally going through every single transaction and finding the source documents. So I'll give you a crazy example. Like you go out and have a business meal, and charge $80 for that business meal. Well, they're going to want to see the receipt for that email, the financial firm, the receipt from the bank statements to confirm and basically audit and confirm that $80 that you claim you spent on your QuickBooks or whatever actually exists. And so there's always a paper trail, and it's the auditor's job to actually go and dig up the papers, which is why it's such a time-consuming exercise, not only for the auditing firm, but for you guys as well, because the auditing firm is going to ask you for all the, hey, I see this transaction here on, September 13th, 2020. Where's the receipt for that? Or where's the bank statement that matches up with the, credit card statement and blah, blah, blah. So usually if it's right at the beginning of a deal, and for example, if you're doing a Reg A, you may even need to have an audited financial that just have a bunch of zeros on them. There might not be any transaction. There might be 3 or 4, then it might not be too expensive. But if you've got a deal that's 2 years in and you've got 1,000 transactions, that means somebody's got to go through every single one of those transactions and back it up. And so that's what audited financials means. It's a very specific, it's technically a legal term, but it's not just having your CPA certified the financials or just somebody give you the check. Somebody's literally looking up the source documents. And one of our CPAs, our good friend Justin here, says, what pointers would you give someone? Oh, I'm sorry. I thought you were commenting on that. I'm going to ask you your question later, Justin. But anyway, so Justin's a CPA, and unless you guys do it, generally the CPA firm is not somebody that is going to want to do the firm. You're going to have to go to an accounting firm and spend a lot of money. And when I say a lot, 30, 40, 50 grand, if not more. So audited financials are not cheap. And so that's probably a big, especially at our level, it's probably, it's when you dissuade someone from wanting to do it. Questions like, man, since I mentioned you, Justin, I'm gonna go with your question. What pointers would you give someone starting a fund of funds investment vehicle for investing in a specific, I'm sorry, you're kind of, for some reason, there we go. What pointers would you give someone starting a fund of funds investment vehicle for investing in a specific real estate deal? Any particular language in the operating agreement? Justin, I'm not following you, my friend. You want to unmute and give me some context? What pointers would you give someone starting a fund of funds? Okay, that's somebody putting together a fund whose intent is basically to turn around and invest in somebody else's deal for investing in a specific real estate fund. Any particular thing? Are you just talking in general, like what pointers when you're putting that fund of funds together?
Yeah, very basic. And I apologize. I was trying to sneak in almost unnoticed.
No worries.
But, and I'll tell you the backstory is, I have real estate clients all over the country, a lot of whom are doing syndications, and they're approaching me to create a fund to then do part of the capital raise through a fund of funds. And I said, I've been in and around this for 20 years as a CPA, but I've never been involved at this level of detail. So I thought maybe it would be a good question to discuss, just like from the beginning. How do you just start? Just to start an LLC? Is there any particular language that needs to be in the operating agreement? Is there anything that we need to be aware of as starting the fund. Would it help if I got my Series 65 license? These kinds of questions.
Yeah, great. Yeah, so good question. So let's go through that. So from an entity standpoint, it's no different than all the other ones. So you're most likely going to be setting up an LLC for your fund of funds. You could do a limited partnership, I guess, if there was a reason, but most of us use LLC, so there's no reason not to do that. But just to remember, you're doing, I used to call these sub-syndications. So they're a syndication. Your fund of funds, that LLC is its own securities offering. It's a syndication that instead of buying a piece of property or whatever you're investing in, you're just going to buy shares in somebody else's company. So the only difference really is that you're buying shares in a company versus buying the real estate. So you're still going to have to worry about all the PPM, right? All the same. The operating agreement from your perspective probably looks very similar to an operating agreement that you generally see on a general syndication deal, right? It's probably the very similar tax language, even I would go to say. The only difference is the revenue that you're receiving from your fund of funds is the distribution that the syndication LLC is giving you, right? So you're just a limited partner in the sub syndication. So they're going to, at the end of the day, they're going to run the property, they're going to have expenses, they're going to pay themselves, they're going to pay the bank, and at the end of the day, there's going to be some distributions available, and those distributions, you're going to get your cut of it, whatever, 5%, 1%, 10% of those distributions. That distribution is your revenue on your side. And so that becomes your revenue. And then of course you're going to have some expenses, but not a ton. Yes, you're going to have your asset management fee. And again, if you had to go travel down and look at the property, you might have some expenses, but most of those expenses are not the typical expenses you're going to see. And the most important thing you have to realize, and you mentioned it briefly on the Series 65, is that because you are now, your fund is investing in a security, right? And shares in somebody else's company, membership units, right? But let's call them share companies. It's no different than you buying stock, Apple stock or Google stock, or just buying Mauricio syndication stock, right? Or LLC units. And so you're in the business, the way the SEC looks at it is Justin is in the business of advising his LLC that he created as to the purchase of securities. And that just opens up all the other compliance mechanisms. So one of them is that they consider you an investment advisor. Yeah, you're advising your fund as to the purchase of securities. So the question becomes, do you need to register as an investment advisor, or is there an exemption to registration? You're in the great state of Arizona, I believe, and I probably at this point should have memorized it already, what Arizona is, but every state has their own exemptions. Almost every state has an exemption. There are a couple that don't, but most of them have exemptions, and it just depends on how onerous they are. Some of them they don't care as long as you don't have 15 of these fund of funds going at one time, which is easy. Others, like Texas and California, saying, yeah, you can do it. You don't have to register, but you're going to be limited in your fund, Justin, irrespective of what Mauricio's doing. Mauricio might have a 506B deal and accepts non-accredited, but all of your investors are going to have to be accredited. Texas and California has that rule. And then others have even more onerous rules where not only do they have to be accredited, but Massachusetts requires a $2 million net worth as opposed to $1 million. And then other states like Washington require that your investors are qualified clients, which are $5 million in investable assets. So that becomes prohibited. So to your point, if you're in a state like, when I've had this issue before, if you're in a state like Washington, and you're like, well, crap, there's no way I can do a fund of funds. All my investors have to be qualified clients and have, a bunch of money that they don't have, then fine. Then you just register, right? And so by registering, that's when you would go, apply to the state, get your some securities license. I'll be honest with you, I don't know if it's Series 65 or Series 7 or Series 82. One of those securities licenses is your state's going to require that you go take that exam and pass. And then you're just going to apply and become a registered investment advisor in the state of Arizona. And that's going to then allow you to go do this fund of funds. Ideally, you skip that. And I don't think Arizona, off the top of my head, I don't think that was one of the ones that would probably require you. I just don't remember if Arizona it limits you to $1 million. I'm sorry. Accredited's only or not. But that's really the one thing, the most important thing you've got to be concerned about. And then there's other statutes that pop up when you start investing in securities, like the Investment Companies Act of 1940. That's where you get this 100 investor rule, the 3C1 language, where if that's an exemption that you can rely on if you have less than 100 investors, which is great. And then, of course, the Investment Advisory Act, because you don't want to be looking like you're just raising money from Mauricio. You want to avoid broker-dealer licenses. So, but taking it back to top level, at the end of the day, you're just doing a syndication on your own. You're setting up an LLC. You're hopefully hiring a securities attorney. They're doing a PPM for you, and you're going through that process. And in your documents, all you're saying is, instead of saying, I'm raising $1 million to go buy this property in Arizona, and I'm going to, raise the rents and increase the occupancy and refi, You're just saying, I'm going to raise $1 million. I'm going to invest it in this particular deal, or I'm going to invest it in deals that I find prudent of other operators that are, in this space, mobile home parks, or maybe they're in multifamily or self-storage or whatever it is that you've decided to do. Hopefully that was a long-winded, but hopefully a helpful answer. Question from
Very good. Thank you.
Thanks. I know it says, for some reason it says Russell Gray, but I know it's not Russell Gray because I saw you there.
Yes.
How often do you do a reverse syndication from sponsor or another investor that wants to participate in the syndication or fund? So let's define terms. How often do you do a reverse syndication from sponsor or another investor that wants to participate in the syndication or fund? I'm not sure if we're talking about the same thing. When I use the term, and you're welcome to jump in here, when I hear the term and when I've used it, reverse syndication, to me, it's raising money for a deal that you already have. So, and I brought that up in the Facebook group the other day, like somebody wanted to sell their single family portfolio because they wanted to go do bigger deals. And I said, well, why don't you just syndicate your own deals? And to me, that's the reverse syndication, because instead of raising money to go buy another deal, you're raising money you're basically transferring your property into the fund. So you already own the building, it doesn't have to be free and clear, but you own a building. And instead of going to buy a new building, you're going to syndicate your own building. That's why I call it a reverse syndication. It's got some benefits. It's got some drawbacks. But before I continue, is that the context you were asking, or do you mind popping in there and saying if that's a context, or is it something else when you say reverse syndication? Well, I didn't hear. So that to me is a reverse syndication. So the benefits of a reverse syndication, I would argue, if you're a first-time syndicator, I love this, right? Because that's the biggest challenge for a first-time syndicator is obviously raising the money, but more importantly, raising the money in time to close, right? And so when you're closing on your own deal, you've got zero closing pressure, right? You can close whenever you're ready, right? Because it's your deal. That could also be a negative, because then you can close whenever you want to close, and it could take you years. You procrastinate, and you just, it takes you forever. But that's one of the benefits, and that's why I do usually recommend, if you're brand new at syndications, and people say, well, how do you get started? I always say two things. One is this reverse syndication. The other one is just go find an experienced operator, go help them however you can add value, and just be a fight. You're not even in it for the money. You're in it for the experience. But reverse syndication, I think that's great. The other benefit of reverse syndication is that where all the skeletons are buried. I mean, there's no surprises. You've got this property, you've owned it for 2, 3, 4, 5 years. You know what the rent rolls are, you know what the occupancy, you know all that stuff. And as an investor coming in, that's also something that's comforting, that they know all the information. So that's a good thing. The bad thing, obviously, from an investor standpoint is, well, is there a conflict of interest? Why are they selling it? Are they giving me the right price? And so you've just got to fit in. You just got to be able to substantiate the price and all that stuff. But generally speaking, it's a great way to start at a syndicator, or if you're doing a fund, and maybe that's where she was going, where if you're starting your own fund and you're looking for, let's say you raise 5 million, we're always concerned about, what do I do with 5 million? How do I deploy it? What if it takes me too long? Well, maybe you go buy your first property, and then you also throw in your own properties as your first couple of properties to get the fund going. So that's another reason you could do it. All of this is fine, as long as you're disclosing. Obviously, you don't want to be doing this and suddenly realize later that there's some conflict of interest that you didn't disclose, and you're just going to throw in your things, and it turns out that you have, which is totally fine. You just didn't disclose the compensation, right? You made some money off of this deal because it's appreciated, or you charge some fees. Again, all of that is fine as long as you disclose it. And so that's something that would be front and center on the disclosure. And if the investors don't have a problem with it, then that's fine. Again, lots of pros and cons on that. Let's go down here. Greg says, hey, Mauricio, great work. Appreciate your efforts. Thank you, Greg. Where can some deal structuring waterfall modeling software spreadsheets? I think you're asking, be obtained. There it is. Be obtained in order to underwrite deals in real time. Underwrite. Sorry about the typos. No worries. If you look, there's 44 people on this call. If you guys want to drop in your favorite underwriting software, there's a lot of people who charge for that, in terms of, hey, they have a coaching program, and so if you join their coaching program, you'll get their spreadsheet. There's others that kind of just give it away. I don't really want to give specific names and stuff, but if you guys want to just drop a name or something, I'm sure you guys have spreadsheets. But Yeah, I don't have any myself, but you know what? Maybe I could start some kind of little thing where I could list, maybe on my website or something, I could have a list of all the free, because there are people who just give it away. The one that actually does pop to mind, I don't know if it's free or not, is the Michael Blanc, is good buddy of mine. So maybe I'll give him a prop. He has an underwriting tool that people really seem to like, and I just don't know whether it's free or you got to be part of his program. But there are a lot of people out there, a lot of coaches out there that have these spreadsheets. I don't have them myself, but if you got a specific question on a type of waterfall, I'm happy to talk about those. Dan, how you doing, my friend? I had a friend ask about buying out a GP or the entire GP team. I think they were the KP from balance sheet and experience. Is this the same one that was on the group this morning, or is it a different one?
Yeah, that's the one.
Yeah, so somebody on the group posted this idea of, there was a bunch of, luckily it wasn't too many. So there's, I think, 3 or 4 GPs. They're all fighting, right? They're just not getting along for whatever reason. It doesn't really matter what the reason is. And they all want to start selling interests and doing all that fun stuff. So how does that work? The first thing you want to do is, as everybody was mentioning on the group, you want to get lawyers involved. And you each want to get your own attorney. So in this case, I think there was 3 of them. So each each co-sponsor would want to have their own attorney representing their interests. I have had situation with 3 of them where if everybody was on the call, maybe you could have the attorney, the SEC attorney, or maybe the real estate. Probably, I have done it with the SEC attorney, actually, with and real estate counsel, but they're acting more as a mediator, right? We can't, if it's one of our clients, we can't take sides. We technically represent the issuer, right? The syndication LLC. And so if something like that happens, I can help facilitate. For example, I would be happy to have all 3 on a call, and maybe we go through the operating agreement together, and I kind of interpret, hey, here are the relevant sections. Here's what it really means. This is what would have to happen, stuff like that. But once there's disputes going around, you got to be careful there. Somebody, I think it was Vessi, shout out to Vessi, thank you. She brought up a couple of great points. Number one, you want to look, there's a bunch of documents you want to start looking at. The first one's going to be your lender agreement, right? There's a lot of lender agreements that have provisions in there that if there's a material change in ownership, there might be a due on sale clause, there might be something going on there, or they might just need their approval. It really depends on which asset manager, they're assuming is going to be running it. And if you're going to bring in another asset manager, they're going to want to approve that, at least get their signing off. You want to obviously look at the PPM and the operating agreement. Most likely, though, that's not going to apply because most PPMs will have a manager LLC be the manager. And so now these 3 individuals are member managers or members of that LLC. And so that's really the operating agreement you need to look at as the management company LLC to see what the procedure is for getting rid of people or buying people out. So that's where I would look at. The one comment that I didn't like was about raising new capital to buy out some of the unhappy LPs. That gets messy. My initial reaction was like, hey, that sounds like a Ponzi scheme. And then I said, I'm not going to write that down because that's not really accurate. But it could be considered a Ponzi scheme. But what it really is you are facilitating purchase and sale of securities, right? So somebody wants to get out, you're raising money over here to basically buy out the other person. You're acting as a broker at that point. So you don't want to be doing that. Plus, you don't want to be treating different LPs differently. So that's another issue that would pop up. But can something be done? The answer would be yes. But maybe the first call is with the SEC attorney, and they act as a mediator to help through the documents. But you got to be real. I'd be more concerned about the lender than anybody else. And then you're also concerned about lawsuits too. I mean, I could definitely see, although it's after the sale of the security, but I could see LPs being upset and say, hey, I invested because, hey, I invested because of Dan's the asset manager. And now he wants to bail or wants to get bought out 2 years down the road. And if I lose money, I could see problems. Although generally speaking, 2 years in, at that point, it's not really a securities issue. It's more just an operational issue. It's, people want to get going, but that's obviously not a good reputational thing. Question, I guess, from Kenneth, when raising capital for a 506B and you don't raise sufficient funds to close, can you start a second 506B to complete the deal? That's an interesting question. I mean, if you can't raise the money, maybe you're asking for, here's the challenge. So I think the answer is going to be yes, off the top of my head. But presumably what you're doing is you're creating another 506B deal with better terms, I guess, or whatever. But here's the challenge, and this is more aptly, and it's the same analysis. It's basically what happens when people are short is they end up having to go to like a private equity company, or maybe they come to Mauricio. Mauricio's got sitting on like a bunch of cash, which I'm not. But hey, I'm sitting on $1 million, and I'm like, hey, Mauricio, can you invest? I want you to invest. I'm short on the raise. Can you lend me $500,000 or invest $500,000? I'll create a special class for you. And that's typically what happens with private equity groups. The challenge is, in order to offer that person a better deal, that's a material change, right? And so you have to go back to all it's almost like doing a 1031. That happens a lot too. Like you're short on the raise, you find a 1031 person and you can do it, but you've got to restructure the whole deal and you've got to disclose that to your all investors. So what happens is, and we did an episode on this on a material change letter, you'd have to go back to all your investors and write them a material change letter. Say, hey, I know that when you sign all the docs and you gave me the money, this was the deal. There's no laws being violated, by the way, but the deal's changed now. Now the deal's going to look like this, and I've got another investor who's going to be a higher class than you. They're going to have priority, or we're going to whatever. And so that has to be disclosed to the LPs, and then they have to have the option. You have to give them in that material change letter the option to back out. Like if you're okay with the changes, fine, sign here, and then here are the updated docs. Please sign. No problem. But if you don't like the term of the deal, then you have the right to back out, and that's what creates an issue, because a lot of people may back out, and that means now you got to raise even more money. But in reality, you got to do what you're going to do, right? You've got two options at that point. You can, if you're short on the raise, you either, you either just cut it off and you return all the investors' money. And the challenge there, and there is a conflict there. That's why that's disclosed. But obviously the earnest money or whatever money went hard most likely is lost. And so that's, and we all know syndicators who have lost that, and that's just part of the risk that you take on. Or you just do whatever it takes to get, that additional capital, whether it's a loan. That's hopefully the easiest one, is like, hey, we're short 500K, maybe you get a short-term loan so you can close, and then you can continue to raise after the fact for the first couple months or whatever. But sometimes that's not good enough, and you've got to go find a private equity group or your rich uncle or whatever it looks like. And that's going to be a material change, which makes it challenging. Drew, the answer is no. Any updates on the SEC's new accredited investor test, release dates, et cetera? I actually checked the SEC website today, and I haven't seen it. But hey, Drew, trust me, the minute that thing comes out, I'll probably go live on YouTube or something. You guys will hear from me like that afternoon. Jared's here with his usual blockchain question. Let's see what it says. Do you happen to know any regulation around AI bots executing restricted security transactions on behalf of investors? Let me just get my mind around that. I definitely have not happened to any regulation, but so an AI bot executes a restricted security transaction on behalf of the investors. I don't know why that's any different than anybody executing restricted securities transactions on behalf. I mean, you can have a financial representative do that for you, whether it's an AI bot or a human being. I have not heard anything. I'll be honest, I'm not actively looking for that, but if it did pop up, I'm guessing it would be in the SEC press releases, and that I check multiple times a week, primarily for Drew's question to make sure when this new freaking accredited investor rule is going to pass or regulations come. But I have not, Jared. I'm sorry, I have not seen any regulation. But thank you. Robbie, Mauricio, are there concerns I should have if I am entering a GP team with a lot of fellow GPs? Example 7. I can tell you right now, yes, you should be concerned even before I finish. On a raise of 2.5. Are there concerns I should have if I am entering a GP team with a lot of fellow GPs, for like 7 of them? Yeah, I mean, that's a pet peeve of mine. I was actually thinking of that today. I don't want to say anything and I haven't thought through it before I get into trouble. So I think I'll say this. All of our top syndicators, and I would almost, I want to say the best syndicators I know don't have 7 GPs on their team. Like even the people I don't know, like even if you hate, I was thinking of Grant Cardone today, like even if you hate Grant, you don't see Grant with 7 other GPs, right? Ken McElroy, you don't see Kenny with 7. There's people in the team, right? But they're part of your team. They're part of your company, right? So Brand is another example, that Open Door. There's like 4 or 5 of them, but they're all part of Open Door Capital, or all of our top clients are just them and their team as the co-sponsors. The minute you have to go find, it's because you don't have the ability to go raise the money on your own. So it's basically, you don't have the ability to go raise $2.5 million. The biggest challenge for me, Robbie, on the concern that I always have with the 7 GPs, not always, but most likely in my experience, the reason there's so many GPs is because 1, 2, or 3 of them are there to bring in capital exclusively. And so you're going to get yourself in that mess. And so if there's only, for example, if there's 7 GPs and only one of them is bringing all the capital in, and all the other ones have some magic, that this deal can't happen without them, then that's fine, right? That's not an issue. But my question would be, what are all first of all, why do you need 7 GPs on a $2.5 million raise? I don't know any other answer other than it's to help bring money. And I would almost ask you, Robbie, like, you're coming in late. What are you bringing in capital? Because if you're coming in late into the game and you don't have something memorialized early that, hey, I'm going to get, let's just say you're coming in and you're going to be a 10% GP owner, and here's all the things I'm going to do for that 10%. Then if you're coming in and bringing capital, what substantial duties are you? I'm not saying you're not doing them, but you're going to have to make sure you document those substantial duties that you're doing, and that they don't somehow overlap with the other 6. But that's a big, there's no way you need 7, 8. And I've seen people with 11, right? Or 13. And I think, to my mind, yes, maybe you need a 30, usually there's 2, right? But again, there's 2 in one company. It's not like it's 2, I'm over here. Like every single deal, there's these 2 people, right? It's not like on this deal, it's me and A and B, and the other one is A and C, and the other one's D. Like they're always together. And then maybe, hey, look, it's a new market, right? Maybe you're expanding into market. So you have the boots on the ground person. So you want to bring in a sponsor, co-sponsor who knows that area really well as an expert, fine. But once you get to 4, 5, 6, 7, and what's critical is that they're different every time. Again, if there are 7 GPs in this deal, and on the next deal, it's the same 7 GPs, and on the next 10 deals or 8 deals or 3 deals, it's the same GP team, that's one thing. But what generally happens is on this deal, you have these 7. On the next deal, it's going to be only 3 of those guys, and there's going to be 4 new people. And on the next deal, there's going to be 5. I mean, it just changes. And that to me is just really, it's just not a good scenario.
Mauricio, amusingly, you gave an example earlier that actually lined up with it exactly. In this case, I'm bringing the majority of the capital as the fundraiser, not titled that way, but substantial duties, including that. And all the other guys, I'm frankly not sure if they can have essential roles. So that's my question. 3 of them are tied at the hip, and I'm going, what's going on here? What do each of you do? But they want to be in there together. So you said it actually that there shouldn't be a concern if there's only one fundraiser, but could you unpack that a little?
Yeah. So first of all, again, if those 3 people, it only becomes an issue if they're bringing in the money, right? So in this case, I'd actually be more concerned about you. Bear with me. I'd be concerned about you because you're coming in, you're going to be bringing in most of the money. Okay, so that's fine. So now you better be able to show substantial duties. Now, if you're like, hey, no, dude, I'm coming in, I'm doing it all. Well, great. I don't have a problem with you. And so then the question was, what are the other 6 people doing? And if they're not, let me give you an example. If those guys didn't bring in a dime, the other 6, then I would have 0 concerns other than what are they doing and why are they in the deal? But I wouldn't have any concerns because they didn't bring in a dime. But if you're looking at one of the GPs and they're like, yeah, this guy brought in 500 grand but he's not doing anything, then I'm concerned that you're going to get mixed up in a scenario where at some point you're a GP, a general partnership. You guys are liable for each other's issues. And so if there is an issue down the road with the SEC and hey, there's unlicensed brokers, it's going to apply to all of you guys. So that would be my concern. If the 3 that want to be in the deal together aren't bringing in any money or bringing in very little money and therefore are doing very little work, that's fine. But if you're bringing in most of the money, then you better be doing most of the work. But it sounds like you would be. So as long as you're doing most of the work, and look here again, let's go through the analysis. As long as you're not getting paid based on how much money you bring in, right? So that's hard because it's like, let's just say you're bringing all of it, you're going to get 50% of the GP. Are you still going to get 50% of the GP if you don't bring in any money? Or are you still going to get 50% of the GP if you only bring half of the money that you kind of said you thought, hey, I think I can bring in $1 million, and you bring in 250? Are you still going to get 50% of the GP? Because if you don't, now it's transaction based, right? So that's challengeable. That's why you want to have, ideally in a scenario like this, 7 of you, I would first of all start from the beginning, because then you have your MO, you have some kind of a memorandum, some written document that just says, hey, even before anything started, hey, this is what Robbie's going to have. He's going to come in, he's going to do A, B, C, D. He's going to help raise capital, but he's going to do ABC. And in exchange for the ABC, he's going to get 10% of the deal. Johnny over here is going to do it. And all of that's done before you even raise a dime. So there's no way anybody can then later on say, well, wait a minute, you got this because no, it's all written down. You don't have that. So, transaction based, number one. Number two, are you doing substantial duties? Sounds like you are, like you're coming in and you're basically, you're the expert here. So you're going to take over, most importantly, the asset management piece. Hopefully you're going to run this project. So then I would argue, hey, you've got your substantial duties part. And the last one is just making sure you spent more time on those substantial duties than you did on raising capital, which based on, I know we didn't very vaguely, but it sounds like you're doing most of the work. So that's fine. So then I would have that analysis with the rest of the team. Like what are their substantial duties? But again, it has to be tied to the more money they raise into the deal, the more scrutiny that substantial duties is going to be. If they brought in zero money, then it's a non-issue. If they brought in 50K, then I'm not going to expect much of a substantial, like if they're just answering the phones and I don't know, that's probably fine. But if you're bringing in 80% of the money, that's when you really want to be able to show what substantial duties they're doing. And again, they want to see, the SEC wants to see it on the asset management side. Like once the deal's closed, right? You closed escrow, you've raised all the money. Now it's time to start asset managing. What are your duties then? What are you guys doing? Right? Because if you're a capital raiser exclusively, most likely you're nowhere to be found, right? So anyway, I hope that was helpful.
Super helpful. Thank you very much.
Thanks, Robbie. Good seeing you, man. Joanne, so regarding that material change, does that mean that deals where they start with some GPs and then the main sponsor brings in more and more GPs added into the deal late in the cycle, right, as additional sponsors, I would do it. So the question basically is, if you bring in more co-sponsors, is that a material change? It depends on what they're doing. If they're going to take over let's take Robbie, for example, pick on you, Robbie. So if the deal is raised and it's like, Robbie is the asset manager on this deal, great. And so everybody invests because they understand Robbie is going to be the main guy. And then later on, Mauricio comes in and it's like, no, now Mauricio is going to be the guy, the day-to-day guy. Robbie's got other stuff going on. So he's going to have a lesser role than before. Well, that's a material change because I was investing because I had confidence in Robbie. I know Robbie, he knows what he's doing. And now this Mauricio guy is coming in. I don't know who this guy really is. I'm not comfortable, right? So that's a material change. Usually that happens when people get taken off. So again, Robbie is the main guy. I invested because of Robbie. And then all of a sudden Robbie bails or leaves. There's a dispute or whatever. And Robbie said, you know what? I'm out. I'm not going to be part of this deal. That's a material change. Because and it doesn't even have to have a major thing. Whatever investor invested based on that person who left, for that person, it's going to be most likely a material change. So it's more when people leave, when people are, if you have in your 7 example, so in your example, that would be a material change. You've got 6 GPs. Robbie's now coming in to raise most of the money and do most of the work. That's a material change because before it was like, Joe over here is going to do the work, right? But if it's the reverse and Robbie's always the main guy and he just brought in Mauricio to, I don't know, help out with some underwriting, it's kind of minor stuff, it's not really going to make or break the deal, then that's not material. It's a very case-by-case basis, Joanne, but that's an excellent question. I'm more concerned when people leave and people have invested based on the assumption that person was going to be in the deal. Great question, Joanne. Doug, Mauricio, you're doing a great job as well. Thank you, Doug. I assume the same syndication rules apply for a syndication bridge loan compared to a traditional 506B or 506C. Yeah. So a bridge loan, well, a syndicated bridge loan. Yeah. A loan is a security. So we've done, I don't think I've done a bridge loan before, but I've done loans before where we set up, I called it a lending LLC. We just set up an LLC. All the investors go into the LLC and the LLC's sole purpose is to lend money to the sponsor's company to go do the deal. And we already know there's a promissory note and we're going to get paid 8% or whatever. And it's the same exact rules apply, 506B, 506C. So it's the same point, Doug.
That's what I thought, Mauricio. It's just a matter of, we've been approached with earnest loans in just a short period of time and it's just not having enough money ourselves. So going out and does this same apply? So I assume such. So thank you very much.
Yeah. Now, if you're an actual, and this is now getting outside of my wheelhouse, if you're a lender, like an actual license, a bank or something, then that might be different. And but if you're just another syndication group and you decide to do it as a bridge loan versus a loan versus an equity, it's going to be the same. Thank you, sir. Joanne, what needs to occur when there is a material change? Is it just disclosing the new sponsors to X? Yeah. So what you want to do, and I forget what episode it was, we went into detail, but basically what you want to do is you want to clearly articulate the material. By the way, first of all, let me just make a quick distinction. There's a difference between a subtle one, and these are kind of my terminologies, but there's a difference between a material change letter and a rescission letter. Okay. A rescission letter happens when you've violated the law. Like, oh crap, I've raised a bunch of money and I failed to disclose something. And, I failed to disclose that so-and-so is a crook or whatever. And I'm like, oh crap, that's a disclosure I should have made. I failed to make it. I violated securities laws. That's what a rescission letter is. Say, hey guys, I've screwed up. Basically what you're saying is I screwed up. I violated securities laws. If you want your money back, you can have it and you want to get out. Right. And that tends to help you in the future. Like even if you get nailed, it's very difficult for them to come back later and sue you for securities violation. A material change letter is you've done nothing wrong, right? There's no violation. It's just there's a change in the deal. Shit happens, right? So in your case, if you thought you started your syndication with 3 sponsors and now there's 4 or 5 or 2 and there's a material change, all you're doing is communicating that change to the investor very clearly. Here's what we originally had planned, and that's what you signed up for. Here's what is actually happening now. And what's critical is you make it very, very clear that if they don't like this change, that they have the option to get their money back plus interest. Now, the plus interest isn't a huge deal because it should be pretty early on. And so they, on a rescission letter, you may have the money for 3 years, 4 years, that might add up, but it's going to be a couple months. But it's got to be very clear that they have the chance to get out. That way, when they decline that chance, it's very clear they can't get back and say, oh, wow, it wasn't clear to me that I had the option to get out. I thought you were just telling me that the change is, and it is what it is. So you want to be very clear that if they don't like it, we have signatures on ours. So if you agree with the material change, sign here, and here are the new PPM docs, go sign the PPM docs. And if you don't like it and you want your money back, check this box, sign here, and we'll refund you your 50 grand or 100 grand plus whatever small interest it is. So it's just a clear letter outlining the changes that have happened. And again, you're not violating the rules, you're not violating the laws. It's just a material change. The most common one that we see these days are, people are short, and so they have to restructure the deal. Now the private equity group comes in and they want to be, preferred equity, and they want first money out, they want last money. They have all these owners' terms. Or a 1031 is another great one. Like, yes, you can do a 1031, but that's a completely different structure. So we have to redo the whole, class A, class B, and now the company's not going to own 100% of the property. You're only going to own 80%, and the 1031 is going to own all those different changes. They're not violation of rules. They're just changes that happen. So, okay. If you got another question, pop it in there. I see somebody already. Is that only after the PPM docs have been created and investors sign? Yeah, it's only after they sign, because if they haven't signed, then they haven't become part of the deal. And so you could just very quickly say, hey, the PPM docs I sent you, ignore them. Here are the new ones. I mean, there's nothing really to say. It's only when they've actually signed the PPM, signed the subscription agreement, wired you money. Now they're actually a member of the LLC, right? They're in the deal. That's when, if there's a change, you're going to have to give them the chance to back out. All right, let's do one over here. And if you guys have one more, maybe I'll have time for it. There was a kind of an entity question, which I liked. Mandy brought this up in the group or somewhere. And it has to do with holding companies in your syndication. So, just in terms of general entity structuring on a syndication, typically you have your syndication LLC, which is the issuer. And then you have manager, just we've been talking about your GP, which is usually a management company, a managing LLC. And then your carried interest, your 20%, 10%, whatever sweat equity you're getting, your carried interest typically is in a separate entity, which is your holding company. And so Mandy was asking that if they wanted to set up the syndication LLC with other people, meaning other sponsors, and you all happen to have individual holding LLCs already, like you already have your asset protection set up and you guys have individual holding companies, our individual holding, could those individual holding companies basically be the Class B members and invest in the syndication LLC? And also the question was, should we set up a separate management company? And the point I wanted to bring up here is that if you guys are syndicating with other, we have co-sponsors, you should consider creating a separate holding company because multi-member LLCs are much stronger than single members. And so everybody hopefully has their own holding company. Like, I have my own holding company. It's me and my wife. It's in Wyoming. It's nice. But at the end of the day, it's still a single member LLC. Husband and wife are considered single. So it has its, and I live in California, it's got its limitations, right? There's half of the states that you're not even assured of getting the protection if it's single member. So multi-member is always better. So if you can have a legitimate business partner, meaning your co-sponsors, be co-members with that LLC, that protection is going to be just much, much bigger. And so I generally would recommend setting up a Wyoming holding company with, hopefully not with 7 members, but with 2 or 3 or 4 members to hold your Class B interest. That way you just get a stronger thing. And then at the same time, when you create your management LLC, that's pretty straightforward, right? All the co-sponsors, all the GPs are going to be the members of that. But who's going to be, how are you going to hold that interest? How are you going to hold your interest in your management LLC? I would not use your holding company, because, the management company is where all the liability is, right? So if anybody gets sued, you want it to be the management company, right? You want it to be the management company because it has no assets. It just manages, money goes in, money goes out. If for whatever reason, I know it's difficult, but not impossible, if for some reason they were able to pierce that corporate veil and get through to the members. So I've sued the management LLC, which is the GP, for $10 million, and I've convinced a judge to pierce it so that that judgment goes to the owners. I don't want that owner to be your holding company that has all valuable assets. I want that to be, some other entity. And generally speaking, I would recommend having your own, you probably have your own management company, your own personal branding company. And that's the company I would generally have as your ownership in the management LLC that you created for this specific deal.